Every business, from a local manufacturer to a multinational tech conglomerate, needs money to operate. Where that money comes from is a firm's capital structure. It is the specific mix of financial sources a company uses to fund its growth. Broadly speaking, a firm has two options to fill this pool of capital. It can issue equity, which means selling ownership shares to investors, or it can use debt, taking on loans or issuing bonds that require fixed interest payments over time. These two sources do not cost the same. In the financial markets, debt is a cheaper source of finance than equity. Lenders accept a lower rate of return because they are guaranteed regular interest payments and hold the first claim on assets if the company bankrupts. Equity investors take on more risk, so they demand a higher potential return. To measure the total burden of this financing mix, analysts calculate the weighted average cost of capital, or WACC. This metric blends the cost of both the cheap debt and the expensive equity, weighted by their respective proportions in the firm's capital structure. WACC is the firm's baseline hurdle rate. For a company to generate actual wealth for its owners, the operating projects it invests in must yield a return higher than this weighted average. Lowering the WACC mathematically increases the overall market value of the firm. Because debt is inherently cheaper than equity, corporate finance seems to point toward a single obvious objective: find the absolute cheapest mix of capital to drive that hurdle rate down. This intuitive pursuit of cheap capital led to a widely held baseline theory known as the net income, or NI approach. The NI approach relies on a straightforward yet deeply flawed logic trap. If debt always costs less than equity, then substituting expensive equity with cheap debt should consistently drag down the overall weighted average cost of capital. This graph maps out the exact relationship proposed by the net income approach. The top line is the cost of equity, KE, and the bottom line is the cost of debt, KD. Notice the middle line, KW, which represents the total weighted average cost of capital. Under this theory, as the firm uses more cheap debt, the KW line slopes steadily downward. Following this line to the extreme far right reveals the logical conclusion. When a firm reaches a leverage of 1.0, financed entirely by debt, it achieves the absolute minimum cost of capital. The implication here is direct. Maximum financial leverage perfectly equates to maximum firm value. But this model is a dangerous illusion. It treats the cost of equity as a static number, assuming that investors will demand the exact same return regardless of how much debt the company takes on. It completely miscalculates how human beings behave when exposed to financial risk. To correct this blind spot, financial theory shifted to a rival framework, the net operating income approach. The NOI approach argues that changing where a firm sources its money does not magically alter the raw operating income the business actually generates. A factory produces the same number of widgets whether it was built with a bank loan or shareholder cash. In 1958, economists Franco Modigliani and Merton Miller formalized this concept into a strict mathematical law, assuming perfect market conditions. Their first law, Proposition I, dictates that a firm's market value is determined strictly by dividing expected operating income by the appropriate discount rate. The division between debt and equity is completely irrelevant to the final number. Contrast this with the flawed net income model. Under the strict rules of Modigliani-Miller, the weighted average cost of capital is not a downward slope. It is a completely flat, horizontal line, regardless of how much debt the firm adds to its balance sheet. Under perfect market conditions, how you slice the capital pie doesn't make the pie any bigger. The firm's true underlying value remains completely static.
This creates a mathematical paradox. If a firm is constantly adding cheaper debt, how can its average cost of capital stay flat? The answer lies in Proposition 2, which operates on a simple rule: nothing comes without a cost. In equation 19.2, we see how the cost of equity shifts. The crucial element is the debt-to-equity ratio. As debt increases, this ratio multiplies the risk premium. The cost of equity, RE, swells upward in perfectly offsetting the cheaper debt. This mathematical swelling is driven by a stark real-world reality. Debt requires fixed interest payments. Higher debt means higher fixed obligations. If the firm hits a rough patch, it still must pay its lenders, drastically increasing the risk of bankruptcy. The mathematical benefit of borrowing cheap money is instantly and perfectly neutralized. Equity shareholders recognize the newly added bankruptcy risk, and they demand higher returns to compensate for it. Moving from the pure equations to the psychology of the market, we see how this risk dictates investor behavior. Financial analysts quantify this specific volatility using a metric called equity beta. As a firm's leverage increases, its equity beta increases with it. The stock becomes mathematically riskier to hold, triggering shareholders to demand a steeper required rate of return. Modigliani and Miller proved that the market enforces this through arbitrage. If a levered firm achieved a higher market value than a debt-free firm, investors would immediately sell their overpriced shares. They would then borrow money personally to buy shares in the cheaper, unlevered firm, forcing prices back to a perfect equilibrium. Financial leverage does not create wealth out of thin air. It simply reallocates the existing risk of the business among different classes of investors. The Modigliani-Miller theorem is mathematically airtight, but it relies entirely on one massive assumption. It requires a perfect, frictionless capital market. Real-world capital markets are messy. They are defined by informational asymmetry, transaction fees, and, most importantly, government intervention. The single most important market friction altering capital structure decisions is the existence of corporate taxes. The tax code doesn't treat all capital equally. When a business makes interest payments to lenders, the government classifies those payments as tax-deductible expenses. They are subtracted from the firm's income before taxes are calculated. Equity faces the exact opposite reality. Whether a firm retains its earnings for growth or distributes them to shareholders as dividends, that money is fully taxed by the corporate tax rate. By heavily taxing equity returns while subsidizing debt interest, the government breaks the perfect mathematical symmetry of Modigliani and Miller. This asymmetric treatment tips the scales heavily in favor of leverage. This unequal tax treatment creates a highly valuable financial phenomenon known as the tax shield. By aggressively using debt, a firm successfully shields a portion of its operating income from the government. That money doesn't disappear. It stays within the firm, increasing the total pool of cash left over to distribute to investors. An unlevered firm next to a levered firm with identical income shows the levered firm holds a higher value, represented by a distinct top block. This extra value equals the corporate tax rate multiplied by total debt. Consequently, the weighted average cost of capital bends downwards as leverage increases. This real-world value increase is driven by the tax code. Because interest is deductible, the government essentially pays firms to take on debt, providing a genuine benefit that doesn't exist in a tax-free market. Capital structure strategy forces a choice between two extremes, capturing the largest possible tax shield while maintaining enough solvency to survive a market downturn.